Hey everyone, welcome to the explainer that's basically going to be your ultimate cheat code for understanding and, more importantly, actually memorizing SA 210 for your ICAI exams. We're going to break this standard down sequentially and logically so you can score top marks without even breaking a sweat. Let's get right into it.
Think about this for a second. Before you even look at a single ledger, before you crunch a single number, how do you actually know you should accept an audit engagement in the first place? It's a massive question, right? SA 210 is all about spotting those absolute deal breakers before the audit even kicks off. Because as an auditor, your signature is on the line, and you really need to know exactly what you're walking into.
So, here's our game plan for today. We'll start with the audit preconditions, move on to the engagement letter, tackle changes and scope limitations, do a quick face-off between SA 210 and SA 580, and finally wrap up with the ICAI exam playbook. All right, jumping right into part one, the audit preconditions. This right here is the true chronological starting line of the auditor's journey. Before you say yes to any client, you've got to figure out if the fundamental ground rules are actually in place. It's a really strict sequence. Step 1, you check the preconditions. Are they met? Perfect. Step 2, if you're satisfied, you issue that engagement letter. And only then do you hit Step 3, actually commencing the audit. If you skip Step 1, well, the whole engagement is just built on a totally shaky foundation. So what exactly are these preconditions? The very first major hurdle is making sure the client is using an acceptable financial reporting framework. I mean, management can't just invent their own accounting rules out of thin air. They have to prepare the financial statements using recognized frameworks, stuff like accounting standards, INDAS, or the Companies Act. If they aren't using a legitimate framework, you literally have no baseline to audit against. It's like trying to referee a game where everyone's playing by completely different rules. Okay, moving to the second precondition. Management absolutely must acknowledge 3 critical responsibilities. First up, they have to actually prepare the financial statements. Second, they've got to design and maintain internal controls so those statements are free from material misstatements. And third, they must give the auditor unrestricted access to all relevant information, records, and personnel. You need the VIP all-access pass, basically. But here's the million-dollar question. What happens if they just flat-out refuse? Well, that brings us to the ultimate deal breaker. If management rejects these responsibilities, or if they're stubbornly sticking to an unacceptable reporting framework, you do not accept the engagement. Unless some specific law or regulation literally forces you to take the job, you walk away. No preconditions, no audit. It really is that simple.
Moving right along to Section 2, let's talk about the engagement letter. Once those preconditions are beautifully satisfied, you get to draft the contract. This ensures everyone is on the exact same page and shields you against future misunderstandings. Your engagement letter has to clearly lay out the objective and scope of the audit. You've got to document the auditor's responsibilities to obtain reasonable assurance, along with management's responsibilities, which we just talked about. You also explicitly name the applicable financial reporting framework, and finally, describe the expected form and content of the auditor's reports. Getting this all down sets a rock-solid common understanding right out of the gate. Now here is a classic trick question that examiners just love to throw at you. Imagine you've been auditing the same exact company for 5 years straight. Do recurring audits require a brand new engagement letter every single year? Take a quick second to think about what the logical answer might be. If you guess no, you hit the nail on the head. A new engagement letter is absolutely not required every single year. I mean, you don't want to generate a mountain of unnecessary paperwork, right? The auditor really just needs to evaluate if the client needs a friendly little reminder of the existing terms or if the circumstances have shifted enough to actually warrant a rewrite. So, what exactly constitutes a big enough shift in circumstances? You're going to need to issue a new letter in a few specific real-world scenarios. For example, if there's a massive change in senior management or ownership. Or let's say there are significant legal changes, or the client's business drastically transforms, like a small local proprietorship suddenly incorporating into a massive company. A new framework, or honestly, even just evidence that the client is misunderstanding the objective of the audit, those should all instantly trigger a revised letter. All right, now we're entering Section 3, Changes and Scope Limitations. This is kind of the danger zone. We're looking at the roadblocks in the auditor's journey, specifically when management tries to change the rules of the game midway through. Imagine this practical scenario. You are deep into the audit. You're finding massive discrepancies. And honestly, an adverse opinion looks totally inevitable. Suddenly,
management comes up to you and politely requests changing the audit down to a simple review engagement. They're basically trying to downgrade the scrutiny just to hide the bad news.
Your reaction in this spot is strictly regulated by SA 210. The required auditor action is crystal clear. You absolutely do not accept that change without a reasonable justification. And let's be real, hiding an adverse opinion is definitely not a reasonable justification. If they push it and you literally can't complete the audit as originally agreed, you withdraw from the engagement entirely, assuming the law permits you to do so, of course.
Now, this brings up an even earlier red flag. Check out this rule straight from the standard. If management imposes a limitation expected to result in a disclaimer of opinion, do not accept the engagement. This is what we call a scope limitation prior to acceptance. If management tells you, hey, we want you to audit us, but you're absolutely not allowed to verify our inventory warehouse, well, that's a massive limitation. You'd end up disclaiming your opinion anyway, so SE 210 says you shouldn't even accept the job in the first place, again, unless a law specifically requires it. Let's pivot over to Section 4 and do a quick comparison between SA 210 and SA 580.
It's incredibly common for students to confuse these two documents, so let's clearly separate them right now. Think about the timing first. SA 210 happens before the audit even begins, while SA 580 happens at the very end of the audit. The document for SA 210 is the engagement letter. It's a contract, but the document for SA 580 is the management representation letter, or the MRL, and their core purposes are totally different. SA 210 establishes the terms and a common understanding, whereas SA 580 actually serves to support the audit evidence you've collected. Keep these firmly separated in your mind.
And finally, we've made it to Section 5, the ICAI exam playbook. Let's take everything we just went over and turn it into a rapid-fire study guide designed for maximum point scoring. When examiners are scanning your answers for professional competence, they are looking for exact terminology, so you need to drop these specific keywords into your written answers: preconditions for an audit, engagement letter, acceptable financial reporting framework, management responsibilities, scope limitation, and establishing a common understanding. Seriously, do not paraphrase these. Use the exact terms. And to help you recall the entire standard when the clock is ticking down, I want you to memorize this one word: agreement. Let's break it down. A, acceptable framework is required. G, gain management's acknowledgement. R, responsibilities of management confirmed. E, engagement letter issued. The second E, evaluate recurring audits for changes. M, modify terms only if reasonably justified. The third E, ensure unrestricted access to information. N, no acceptance if preconditions fail. And finally, T, terms agreed before the audit starts. Honestly, if you can just scribble down AGREEMENT on your scratch paper, you practically have the entire SA 210 standard fully outlined right in front of you. So, with the agreement mnemonic locked in your brain, you are definitely ready for exam day. But I want to leave you with this final thought. SA 210 isn't just boring paperwork. It's the gateway that protects the integrity of the entire financial ecosystem. Think about it. If an auditor's foundation is flawed before they even begin their work, can we truly trust a single number that follows? Thanks so much for joining me on this explainer, and happy studying.